Welcome to the deep dive. Today, we're using that rigorous value investing checklist to look at a true giant of the market, the biggest U.S. healthcare company, UnitedHealth Group, or UNH.
And this is a fascinating one because UNH is sending, well, some of the most contradictory signals we've seen all year. It's an absolute powerhouse.
It really is the largest managed care company in the country.
But then you have 2025.
Right. And in 2025, the stock just went through this incredibly painful correction. It plummeted nearly 40% from its high. I mean, the headlines were all panic and lawsuits, and costs were just soaring.
And yet, right in the middle of all that turmoil, you get this classic value signal flashing. Berkshire Hathaway.
The smartest money in the room.
Exactly. They step in and take a huge 5 million share stake. That's about, what, a $1.6 billion bet?
So that's our mission today. We have to reconcile this conflict. We're going to put UNH through a kind of Buffett-style checklist and figure out what makes this company a giant, why it stumbled so hard, and why some deep value investors saw a huge opportunity when pretty much everyone else was running for the exits.
To really get it, you have to start with the company's core architecture. It's almost like a dual-engine company. You've got UnitedHealthcare, which is the massive, traditional insurance side.
The payer.
The payer, exactly. And then you have Optum. And Optum is the health services arm, and it's all vertically integrated. That combination is, it's the key to their entire strategy.
And the scale is just, it's hard to wrap your head around. We're not talking about just a major player. This is the undisputed leader. They have over 22% of the entire accident and health insurance revenue market share.
The market power is just undeniable. And you see in the brand strength, too. UnitedHealthcare has been the most valuable healthcare payer brand for, 9 years running now?
Yeah.
Valued at almost $48 billion in 2024.
So this isn't just market dominance.
Yeah.
It's more like an institutional bedrock.
It is.
Okay, so let's unpack that competitive engine, the moat, as they say. When you look at their rivals, Elevance Health, Cigna, Humana UNH, just consistently has this massive lead. What allows them to do that? What is it about Optum that gives them an advantage that others just can't seem to replicate?
It really boils down to scale meeting synchronization.
Yeah.
The moat isn't just about the size of their network. It's about this unique vertical integration they have through Optum.
Right.
Most insurance companies are just payers. They manage risk, they cut checks. But UNH, through Optum, does, pretty much everything.
So tell me more about that integration, because just listing the services, PBM, clinics, home health, it doesn't really explain the financial advantage. What's the real difference there?
The difference is the data feedback loop. That's the core of it. Optum is basically this enormous internal data machine. They run the pharmacy benefit management, the PBM,
right,
which is that whole complex world of negotiating drug prices.
And deciding what gets covered.
Exactly. And they own clinics. They own home health providers, especially after buying companies like Amedisys.
So they aren't just sitting back and waiting for claims to come in. They're actually generating the data and controlling things on the cost side of the equation.
Precisely. It means UNH doesn't just pay claims. They try to predict and even prevent them. They use all these proprietary data insights to manage chronic conditions, to steer patients towards lower-cost care settings, and to get the absolute best discounts on pharmaceuticals.
So they can underwrite risk in a way that their competitors just can't.
They can't, because the competitors are relying on external data that's often delayed. UNH has it in real time.
But wait a second. Being both the payer and the provider, isn't that the definition of a conflict of interest? It sounds like a huge regulatory target, especially with them steering patients to their own Optum-owned services.
And that is the essential trade-off. You've just hit on the single biggest risk, and we're definitely going to get into that.
Yeah.
But from a pure profitability standpoint, this unified structure it makes cost management and coordination so much more efficient.
It's a durable advantage.
It's incredibly durable because you can't just build this kind of integrated system overnight.
And the market clearly sees the value. We talked about UnitedHealthcare's brand, but Optum itself is the fourth most valuable healthcare brand overall. We're talking over $20 billion. It's really two powerhouses under one roof.
That's the perfect way to describe it.
Okay, let's pivot to the stress test. If this moat is so wide and their scale is so dominant, what on earth drove that violent 40% stock plunge in 2025? It sounds like the company got hit by a sort of coordinated three-pronged attack.
That is exactly what it was. A triple threat that just completely spooked the market. You had massive unexpected operational costs, real explosion in medical cost inflation, and then a lot of leadership instability mixed with regulatory pressure.
Let's start with that operational shock. The cyber attack.
Right, the Change Healthcare ransomware attack in February 2024. This wasn't just some IT glitch. This was, for a time, it crippled the financial nervous system of a huge chunk of the U.S. healthcare industry.
Because change is so embedded in the billing systems.
It's everywhere. The attack caused this widespread paralysis. It impacted payments to providers all over the country.
And what was the actual financial fallout for UNH?
It was immense. The attack cost them over $2.3 billion in 2024 alone. That disruption just crushed their earnings. Diluted EPS fell to $15.51, and their free cash flow dropped by a staggering 19% year over year.
That is a measurable, catastrophic hit.
It is. And on top of that, they're fighting rising medical costs, real persistent inflation.
This is the sustained headache.
Right. And we track this with a key metric, the medical care ratio, or MCR. It's basically the percentage of premiums they have to pay out for patient care. And that was already climbing from 83.2% in 2023 to 85.5% in 2024.
And then it spiked even higher in 2025. This is the number that really matters.
Yes. And this is where the real panic set in for analysts. By the third quarter of 2025, that ratio had spiked to 89.9%.
Almost 90%.
Just think about that. If your MCR is 89.9%, it means for every single dollar of premium you collect, you're spending almost 90 cents directly on medical care. That leaves you with just over 10 cents to cover everything else.
All administrative costs, operations, taxes, and profit.
And profit. It all has to come out of that tiny slice.
An 89.9% MCR just sounds terrifying. Does that mean the company is one bad flu season or one surge in some expensive new drug away from basically breaking even on the insurance business?
It brings them dangerously close. This relentless cost creep is just eating directly into their margins.
Yeah.
And it puts enormous pressure on that integrated Optum model to deliver even bigger cost savings.
And then, compounding the crisis, you had the leadership change, which really signaled how serious things were.
It did. When CEO Andrew Whitty stepped down in May 2025, they didn't go looking for someone new. They brought back a legend, former CEO Stephen Hemsley.
The architect of Optum.
He's the guy. He created the Optum strategy, took UNH from number 103 on the Fortune 500 list all the way up to number 7. His return was a huge vote of confidence in the long-term plan, but it was also a clear admission of the short-term crisis.
Okay, so we've got a dominant business protected by a deep moat, but it's dealing with crisis-level margin compression and these huge unexpected costs. So now let's switch gears to the value investor's perspective. The headlines were screaming panic. Let's pull out that quantitative checklist and see what signals Berkshire Hathaway probably saw that let them look past all that noise.
Well, value investors look for resilient profitability, not just temporary earnings dips. And despite the cyber costs and that MCR squeeze, UNH's underlying profitability is still, far superior to its peers.
Let's compare the return on equity, the ROE.
Okay, so UNH's current ROE is at 17.48%. That is significantly higher than the sector average, which is floating around 12%.
And how does that stack up against, say, Humana?
It crushes them. Humana is generating only 7.2% ROE. Elevance is better at 12.6%. UNH is clearly still the most efficient machine in the industry when it comes to generating returns for shareholders.
But the real test for management anyway is capital efficiency. Are they actually creating value with the money they invest? That's the whole return on invested capital versus the cost of capital.
And this is where they're walking a tightrope. Right now, UNH's return on invested capital, their ROIC, is 8.94%. Their required cost of capital, the WACC, is 8.0%. So yes, they are still creating economic value. ROIC is still above WACC.
But those numbers look incredibly tight. If that margin compresses any further, if the MCR ticks up just one more point, they basically stop creating value. How close is that knife's edge?
It is alarmingly close, and that is exactly why the stock fell. You can see the danger signal that ROIC was over 13% back in 2022. The market correctly saw that diminishing return, but, and this is the key point, the fact that ROIC is still above WACC suggests the fundamental business model hasn't broken. Not yet.
And this is where their cash strength becomes such a powerful buffer. Because despite everything, their ability to just generate cash remains incredibly robust.
Their cash flow is a fortress. It's exactly what a value investor wants to see during a downturn. Cash from operations hit $24.2 billion in 2024. That's 1.6 times their net income.
Wow.
The free cash flow yield right now is 5.66%. That's excellent liquidity. And that financial firepower is what allowed them to return $16 billion to shareholders through buybacks and dividends last year. It shows management is still confident.
And we can apply that classic Buffalo rule, which is just a simple, pragmatic check on valuation safety.
Right, the Buffalo rule. The basic idea is that a stable business's earnings yield should easily beat the safest return you can get, like a 10-year Treasury bond. UNH's earnings yield is 5.73%. The 10-year Treasury is sitting around, what, 4.14%?
So it clears that hurdle easily.
It satisfies that key value criteria.
Yes. And maybe the most compelling signal of all didn't come from Wall Street analysts, but from the people inside the company.
The insider confidence is just striking. When Stephen Hemsley came back as CEO in May, he put his own money on the line, a lot of it. He bought $25 million in shares. The CFO, John Rex, bought $5 million.
That's a huge bet.
It's a massive personal bet. When the executives with the clearest view of the internal numbers and the recovery plan are doing that, it signals a very strong conviction that the worst is over and the stock is undervalued.
Okay, but now we have to address the cautionary side. Even with those strong metrics, the cash flow, the insider buying, there are very serious risks here that keep this from being an easy, stress-free buy. Let's talk about that big regulatory cloud hanging over Optum.
This is probably the biggest long-term threat. UNH's entire competitive advantage is based on integration, and regulators are now actively challenging that very model.
So you have the DOJ, the FTC?
Right. There are active investigations from both the Department of Justice and the Federal Trade Commission into their Medicare Advantage coding practices, basically how they get paid by the government, and into Optum's pharmacy benefit management practices.
And the political pressure after the Amedisys home health deal, that also signals a bigger trend, right? Regulators just very skeptical of this kind of large-scale consolidation in healthcare.
Absolutely. And these aren't minor compliance issues. These investigations strike at the very heart of their profitability model. They create constant headline risk and, the potential for severe penalties or even mandated changes to how they operate.
And then there's that margin compression we talked about, that slide in ROIC down towards WACC, 8.94% versus 8.0%. That is the single clearest quantitative danger signal. The business is facing diminishing returns because of that MCR crisis.
And that unpredictability makes forecasting treacherous. It's why a firm like Morningstar, for example, kept its long-term fair value estimate at $530 a share, but at the same time, they raised their uncertainty rating to high.
So the underlying value is there, but the path to actually realizing it is extremely volatile.
Exactly. Too much regulatory and cost unpredictability right now.
So after all that, what does this mean for the valuation picture now that the stock's been hammered so badly?
Well, the market price absolutely reflects that fear and uncertainty. The current PE ratio is 17.6, which is well below the sector average of 23.6. And if you run a robust discounted cash flow analysis on their future earnings,
A DCF model?
yeah, projecting their future cash flows with moderate growth, you get an intrinsic value of approximately $419 per share.
And with the stock trading around $330 in late 2025.
That implies a margin of safety of about 21%. Now, for a disciplined value investor, that cushion against all this uncertainty might just be enough for an entry point. They believe the regulatory risk is manageable and the cost inflation is temporary. They're buying a powerful company at a substantial discount.
Okay, let's wrap this up.
To summarize, UNH has this dominant market share, an integrated data-driven moat with Optum, and incredibly resilient cash flow. But that superior position is being threatened by two massive forces: catastrophic margin pressure from medical inflation and heavy regulatory scrutiny that targets the very integration that gives them their edge.
So for anyone listening who's considering this company after its big drop, what are the actionable insights? What are the two key metrics you have to track to see if this investment thesis is holding up?
You have to diligently track two things. First, the outcome of those DOJ and FTC investigations. Any forced separation of their business or a huge financial penalty would fundamentally change the entire story.
And
Second, you have to watch that medical care ratio, the MCR, in the fourth quarter of 2025 and the first quarter of 2026. Management has to prove that Hemsley's return and their Optum strategy are actually working to bring that 89.9% number back down.
That MCR number really is the metric to watch. And to close, let's leave you with this provocative thought. If UNH's entire core strategy depends on vertical integration merging the payer and the provider to create efficiency, and that very strategy is now under the microscope from antitrust regulators, what does the future of the American healthcare industry even look like if the market leader is forced to slow down or maybe even unwind its integrated approach?
It raises some profound questions about the entire direction of healthcare in the U.S.
Thanks for diving deep with us into the very conflicted world of UnitedHealth Group. We'll catch you next time.